As the year comes to a close, it's the ideal time to organize your financial records and get ready for tax season. A smooth year-end accounting process does more than keep you compliant. It also gives you a clearer view of your business's financial condition, helping you make better choices as you head into the new year. When your books are accurate and up to date, you avoid last-minute stress and reduce the risk of filing errors. A solid year-end close starts with reviewing your accounts and confirming that every transaction has been recorded properly. Reconciling your bank statements, credit cards, and loan balances helps you catch mistakes, missing entries, or duplicated transactions before they become problems. It's also important to review your expenses. Make sure categories are correct, separate personal and business spending, and confirm that all receipts are organized and easy to access. Clean expense records help you claim the deductions you qualify for and keep your reports accurate. Once your accounts and expenses are in order, update your financial statements. Your balance sheet, income statement, and cash flow statement should reflect the full year's activity. Reviewing these documents helps you track performance, spot trends, and identify areas that need attention moving into next year. Don't forget to follow up on unpaid invoices and outstanding bills. Collecting overdue payments strengthens your cash flow before year-end, while settling your own payables helps you start the new year with a cleaner slate. If your business manages inventory, take the time to do a physical count and compare it with your records. This step helps you correct any discrepancies and adjust your books before closing the year. Finally, back up all financial data and prepare the documents your CPA or tax professional will need. When everything is organized and complete, tax season becomes far less stressful and much more manageable. Steps to close your books smoothly. Closing your books at the end of a month, quarter, or year helps keep your records accurate and gives you reliable data for planning. A steady process also keeps you compliant and reduces the chance of surprises later on. Organized transactions begin by reviewing all transactions for the period. Make sure income, expenses, and transfers are correctly recorded and placed in the right categories. Clean data here prevents headaches when you prepare reports. Review accounts payable and receivable. Check that all invoices have been issued and payments are recorded. Follow up on overdue balances and confirm that all bills on your end are updated. Staying on top of payables and receivables keeps your cash flow steady. Adjust entries and make corrections. Look for missing entries or mistakes and fix them before closing the period. This may include adjusting depreciation, prepaid costs, or accrued expenses. Getting these entries right helps avoid problems during tax time or future audits. Close temporary accounts once everything is updated. Transfer revenue and expense totals to retained earnings. This resets your accounts for the next period and keeps your financial statements clean. Reconciling accounts. Why accuracy matters. Reconciling your accounts is one of the most important steps in the closing process. It helps confirm your books match external records, like bank and credit card statements. Identify discrepancies. Compare your internal records with external statements and watch for differences. Missing entries, duplicates, bank charges, or timing issues are common. Correct errors. Promptly address inconsistencies right away. Fixing small issues now prevents bigger problems later and keeps your reports dependable. Benefits of accurate reconciliation. Accurate reconciliations lower fraud risk, strengthen cash flow visibility, and make audits and tax filing much easier. It also gives you a clearer view of your day-to-day operations. Financial documents you'll need for filing taxes. Getting your documents organized before tax season cuts down on stress and helps you file accurately. Good preparation also helps you claim the deductions you qualify for. Key documents to collect. Make sure you have income statements, expense records, bank statements, receipts, payroll reports, and past tax returns. Businesses should also gather W-2s, 1099s, and forms tied to deductions or credits. Organize by category. Sort your documents into groups such as income, expenses, and deductions. Digital folders or features inside your accounting software can make everything easier to track. Prepare for tax professionals. If you work with a CPA or tax preparer, give them organized, complete records. This helps them file correctly and spot tax-saving opportunities. How to prepare for an external audit. Preparing for an external audit isn't just about compliance. It also shows lenders, investors, and partners that your financial records are solid. A well-organized approach keeps the process smooth from start to finish. Review financial records. Go through your financial statements, reconciliations, and key reports before the audit. Correct errors so the information you present is accurate. Organize supporting documents. Keep invoices, receipts, contracts, and statements easy to access. Good documentation saves time and helps auditors understand your transactions quickly. Communicate with your auditor. Stay responsive and open during the process. Answer questions promptly and provide documents as needed. Clear communication helps the audit move along without delays. Implement recommendations after the audit. Take the findings seriously. Making improvements strengthens your internal controls and reduces risks going forward. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides. See you in the next video.